Hello everyone and welcome to your Glassnode video report for week 49, 2023. Well, Bitcoin continues to post fairly remarkable performance this year, having punched up above the $40,000 level, which is one of these human key psychological round numbers, and getting up at the time of recording at 41,700, having pulled back just slightly from under 42,000. So Bitcoin has had a pretty spectacular year, and really we're going to be spending a bit of time looking at cycle performance, price performance, and just what this kind of rally, just trying to contextualize things and where Bitcoin kind of fits in the general scheme of things. So Bitcoin is one of the best performing assets in the world. It is actually now, as of the time of recording, has overtaken Berkshire Hathaway as the 10th largest asset in the world. So pretty remarkable stuff. And Bitcoin is up over 140% year to date versus the US dollar. Now it's up a lot more versus many other currencies. And in this, we're actually going to compare it to gold as well, being its kind of analog counterpart, which it has more than doubled against over the course of 2023. And what we're also going to look at is just how eerily similar some of these cycles are that we've seen play out time over time. Some of the different workbench charts we can use to actually plot these over each other and some of the techniques that we use there. And we're going to close out by a look at Bitcoin investors, as we often do, and looking at how a super majority of them have essentially come into the black. They're now up on their position. So the majority of Bitcoin holders now in profit. And in many ways, this kind of signals a bit of a transitional phase for really, I would say, the last maybe 12 months, I would say. We've been describing this kind of recovery mode, this transitional recovery phase from what was a pretty dire 2022 into something that's, well, it's a little bit less dire when we're up 140% on the year. And very much it looks like a bit of a transition from that uncertain recovery phase to what I'm just going to call enthusiasm. We now have this kind of break above, particularly that 30,000 level, which we covered a couple of weeks back, that coin time mean price that I believe is the right frame of reference or when this really happened. But looking at this transition from recovery across to enthusiasm. Now, just before I get started, you will find in the description below, we've actually got a second YouTube channel called Glassnode Clips. If you're looking for any of these bite-sized chunks, it's essentially looking at these more digestible single insights, trying to capture just a handful of these different topics and charts, and delivering it in a slightly shorter format. So if you are looking for something that's a little bit more bite-sized, do check out our second channel at Glassnode Clips. And otherwise, let's get stuck straight into the analysis. Okay, so we are going to start with a bit of a relative performance. What we're looking at here is the indexed year-to-date performance versus the USD here in orange, and then we have versus gold here in the yellow. Now, why do we do this? Well, gold is essentially the old school store of value. It's what many investors would generally move towards if they're looking for that kind of sound money allocation. And what we can see is that they're more or less the same chart because in many ways, gold's volatility is substantially lower. Now, why particularly did we choose gold this week? Well, gold actually punched out to a new all-time high for a very, very brief period of time, getting up about 2,150 on the USD. So that is now an all-time high across every fiat currency. But just putting things into a bit of perspective, Bitcoin is up over 140% versus the US dollar this year. And it's up over 100%. So it has more than doubled versus gold over the course of this year. And in many ways, this is, I mean, we've been talking about over recent weeks, this kind of institutional side. The more that institutions start to look into Bitcoin, the more we start to see these larger transaction volumes moving around the network. We're seeing this institutional adoption slowly starting to grow. And in many ways, Bitcoin is in a bit of competition with gold for that sound money allocation. And I think most people looking at this problem probably don't expect it to be immediate. It's going to be one of these slow marches where Bitcoin may start as a small percentage allocation. And it slowly grows, or in this case, very quickly grows, depending on how the market performs. But as these ETF vehicles start to come to market, these kind of things start to make a lot more sense because at the end of the day, everything in investing is a relative game. And that's really what we're going to be looking at here is a bit of this relative performance because that is in many ways what matters in the sense of opportunity cost. Now, speaking of relative performance, I find this chart quite interesting. We've got a couple of traces here. What we're looking at is market cap performance. So essentially, how much has the asset grown? Market cap it's not the best metric, but at the same time, it's also a way to look at the overall network growth. We're not just looking at price because obviously price has different dynamics depending on coin supplies. So what we're going to look at here is the overall performance of Bitcoin, which, as I mentioned, is up over 140%. And we can see a fairly significant divergence between Bitcoin and Ethereum down here. I'm just going to turn on my presenter mode here so I can actually see my tooltip and pull up these traces. But you can see that Ethereum has been lagging somewhat relative to BTC. In the pink curve down the bottom here, we actually have the overall altcoin sector. So basically everything excluding Bitcoin and Ethereum, and it does exclude stable coins as well. So we're only looking at crypto assets, not dollar denominated stable coins. So what we can see is that for Bitcoin, its market cap has actually grown 157% on the year, which again is quite remarkable. And again, the difference there between 140% on price and 157% on coins is additional coins are coming into the market. So that extra supply, in many ways, we can consider mining to be a source of demand because they're essentially buying those coins with power rather than dollars. And those coins need to be either distributed or held onto. So there is still a purchase price, but that explains why there's a difference there. Ethereum, on the other hand, is up about 85% on the year in terms of its market cap. And the wider altcoin sector is actually up only 67%. So we are seeing that Bitcoin dominance does continue to grow. It really has been Bitcoin season for pretty much the entire of the year. And this chart really just helps illustrate that that gap has actually been widening during this period of time. And just from my own personal experience, this is very much similar to what the 2019 and 2020 periods were like. There was this kind of Bitcoin tends to see its dominance expand and grow during these recovery and even into the early bull market phase. This is something that we have seen in prior cycles, and it is interesting to see it playing out in the data as we speak. And notably, we're actually seeing that altcoins in general are catching up to Ethereum. So Ethereum really has been a bit of a lagger during this period of time. It really has been struggling against both BTC and indeed against the relative altcoin market as well. Now, sticking with this concept of cycles, we're going to look at Bitcoin's price performance relative to some different benchmarks, just to kind of see in terms of duration and performance and things like that. So here we're looking at price performance of Bitcoin cycles. We've actually used Workbench here to do two things. We use a combination of what's called the subset function, which will take a slice of between two different dates. So we've taken the Bitcoin price and sliced it for the different all-time high periods of time, different epochs, let's call them. We've then used a second function called shift. So we've taken that sliced start and end date, and then we've shifted them so that they all have the same indexed starting date and price. So this is actually an index performance of the different cycles. Now we're going to ignore the orange one here because this is the very early 2011 to 2013 cycle, and it's just not really a good comparison point. Much better to look at the 2013 to 17 in red and the 2017 to 2021 in blue relative to our current cycle. Now, just note, for those astute in the audience, you will notice that we actually start this all-time high back in April 2021, not the mathematically correct November 2021. Now, the reason for this we covered way back in week 4, 2022, when we did our report called Sizing Up a Bitcoin Bear, where we really showed that there was a bear market well and truly in effect from a sentiment perspective, from a market structure perspective, certainly from an on-chain view. Almost everything that we look at signified that the bear market was in play in terms of the human layer. Yes, the price went higher, but adoption trends didn't. And the overall market was really not in a bull market, even though we hit a new all-time high. So from that instance, we look at this from a psychological perspective. That's certainly the angle that I like to come at the problem from. And in that instance, we are going to start our bear market back here in April, when that sentiment bear market really kicked in. That's enough prelude. Let's get into it. What we can see is that overall performance, we'd actually see eerily similar. We have seen this kind of long-term recovery duration, right? This overall bear market into recovery and getting up to roughly around a 40% drawdown from all-time highs where most of these cycles have been. It is eerily similar to these previous market cycles that we've seen. So, Bitcoin is a strange cyclical beast. And again, this of course doesn't mean that it's going to follow the red and the blue line. We don't know what the future holds, but it is quite intriguing that at this particular moment in time, both of the previous cycles had this similar drawdown from that all-time high. Now, if we look at it from the cycle low, which I think we can argue is probably a little bit easier to select relative to the cycle high, It doesn't have as much nuance here. We're just basically taking it from the low set after the FTX collapse. We are again at a very, very similar juncture. So if we look back to the prior cycle, we're in 2019, just before the March 2020 sell-off actually kicked in. Whereas in 2016, we were well and truly forming this long, slow, grinding pattern higher. Again, we're going to exclude these earlier cycles because they're just too immature to really be overly comparative. But nevertheless, they're kind of a useful reference point just to kind of see how the market has evolved over time. But the interesting dynamic here is that Bitcoin duration seems to be reaching this, let's call it the 4-year cycle. It seems to be finding this kind of resonance around this particular duration for the recovery. Now, this is a chart I've actually been, if any of you have met me in person recently, this is one I've been referring to quite a bit because I really like, sometimes when you visualize things differently, it just gives you a really nice perspective. So this particular chart, as you can see, I've used the subset function again in Workbench and isolated only the bull markets. So I'm only looking at significant and meaningful uptrends. And what I've done then is obviously color-coded them, right? So we've got our different epochs. And then up the top here, you can see these drawdown traces. Now, these drawdown traces are from the local high of this particular indexed price trace. So the way to think about it, we're in a bull market. What I want to see is how deep are the corrections, right? That's the frame of reference I'm coming at it from. We do have a dashboard for both BTC and Ethereum that covers this particular chart, as well as the opposite, which is bear market rallies. From the low in a bear market, how high do the rallies actually go? Basically, we're looking for how deep is the counter trend move. Now, the thing that I've been talking about quite a bit that I find fascinating is that in our current market cycle, you can see how shallow. This second bar down here is just a Fibonacci level because many people are familiar with the Fibonacci pullbacks, 23.6%. We hit that level many, many times during the 2017 market, and we dipped well and truly below 60% drawdown during that March 2020 event here in 2019, 2020. We've had some pretty serious pullbacks during previous uptrends. We have not had anything remotely close. In fact, we've barely even got a 20% drawdown on a closing basis. So in many ways, this 2023 market has been extremely resilient, impressively so. We have seen a lot of support starting to come in, and Bitcoin has really been grinding sideways and up for the majority of the year. And again, putting in 140% year to date in terms of returns, in terms of price, and barely suffering a 20% drawdown once or twice during this market cycle. It is quite impressive. So it's just one of those things. We're just looking at kind of the objective price data here. Again, we haven't really even tended beyond just price, but sometimes I find visualization using techniques like this to be quite useful. And certainly this is what we spend a lot of our time here at Glassnode playing around with Workbench to try and just find these different visualizations that quite often can help us contextualize and put things into context. Okay, so that's enough with price. Let's get into the really good stuff, which is our on-chain side. What I'm going to look at here is just a snapshot or a way to think about exchanges, because the Bitcoin landscape, strangely enough, is starting to evolve, and this is partly to do with inscriptions. So I've got two traces here. One is the number of deposit transactions, not volume, just the number of transactions depositing to exchanges on the left and withdrawing on the right. We are actually just going to focus on the deposits just to simplify everything. We can see that the number of deposits has been declining. Now, in a bear market, this actually makes sense, right? We get a bit of an uptick during panic events like FTX and when we get a bit of a recovery rally, but you can see a fairly sustained over a 2-year period decline. And actually, we've seen a significant decline in deposits recently. Now, we can see similar things on our withdrawals. Suffice to say that generally speaking, withdrawals and deposits, inflows and outflows tend to move fairly in tandem. So we can often look at those things fairly similar in a fairly similar light. But the question is, are we actually seeing a decline in deposits, right? Are we actually seeing the amount of deposits declining because people are depositing less, or is there some other mechanism? Now, this chart may be a little bit tough to get your head around initially, but Bitcoin block space has been full for the vast majority of this year, and this is largely to do with inscriptions. So just consider this. Each Bitcoin block has a limited amount of data that we can fit into it. Now, that can either be traditional monetary transactions, which includes deposits, or it can be more recently inscriptions. So essentially, whoever's paying the highest fee and is able to fit into that block, but we know the miners are putting these blocks together, they essentially get included. So the question is, are we actually seeing deposits declining, or are deposits simply not willing to pay a high enough fee to outcompete inscriptions? So because there is a constrained space, it is a bidding war, and it's essentially whoever's willing to pay the highest. So the orange trace here is the dominance, right? So of all transactions with no filtering applied whatsoever, of all the transactions confirmed on a daily basis, what is the dominance of deposits to exchanges? And we can see a significant decline, really. And this aligns with the first emergence of BRC20 in terms of inscription. So lots and lots of text-based inscriptions. We covered this back then and a couple of episodes since. And on that basis, absolutely, yes, deposit transactions are only accounting for about 11% when they used to account for about 23%. So yes, by that logic, it has. But then the question is, okay, well, how much if we filter out all of the inscriptions and we only look at monetary transactions? So let's basically filter out those inscriptions and just look at monetary transfers. What is the dominance by that metric? And that is what the blue curve is showing. And you can see we have in fact seen a bit of a decline. That's down to about 12%, coming down off about 24, 25, 26%. So we are in fact seeing a decline in overall exchange deposit activity. Now, that doesn't necessarily mean we've seen a decline in exchange volume. So remember, I was talking about transaction counts. So we've got a smaller amount of transactions moving around. And by the way, we touch on this a bit more in the actual newsletter, the written version of this, which again, you'll find in the description below. But what I want to look at here, this is the overall deposit and withdrawal volume to exchanges in BTC terms. And you can see that really, since about May, we've seen an expansion and more recently, a fairly large expansion of the volume. We're seeing more volume flowing in and out of exchanges, just in general. Now, also, this is actually a really important chart just for a lot of people who look at on-chain data. I reference this one quite a bit. You can see the black line here. This is the net flow to and from exchanges. So that's looking at deposits minus withdrawals, right? How much does the actual exchange balance change? You can see it's actually quite small relative to the inflows and the outflows. On any particular day, I mean, in recent history, we've seen 44 to 45,000 BTC flowing in and out. These are significant volumes, right? We're talking about billions of dollars worth of Bitcoin flowing in and out. And of these Bitcoin, they all carry an on-chain signature. This is why we can keep coming back and looking at on-chain data, because whilst a lot of the trade volume happens on and off chain, we still have billions of dollars worth of information being printed into the chain every single day. And that's really where a lot of this stuff comes from. And by the way, this is just exchanges. There's also all sorts of other transactions going on. Now, what I was really trying to get at here, we have a lot of volume. We've got volume really ticking up. And if we look at our volume momentum, we often use these momentum charts, which is just a slow and a fast moving average, just to simplify things. But we're looking for what is a meaningful amount or a meaningful trend in this behavior. We have an uptick in overall exchange volume. So there is a substantial uptick in exchange activity. And if we look at that from the perspective of there being fewer transactions, more volume. If you do a mean on all of this, it's basically telling you that we have more large transactions moving in and out of exchanges. Going back to the beginning, what I was talking about with ETFs down the horizon, it feels like we have a bit of an institutional, or at the very least, the average transaction is getting bigger. Retail and smaller Bitcoin holders are choosing less so to deposit their coins. So we're seeing less small deposits and a lot more larger deposits. And again, this often moves in tandem with withdrawals, and we are seeing it on both sides. So the average size of transactions moving around the Bitcoin network is starting to head higher in an era where we're seeing more and more institutional adoption and a doubling versus gold. We are seeing this kind of size component starting to come into the network itself. Okay, so the last topic I want to touch on today is about the Bitcoin investor, because we like to always focus on these. And again, this is kind of interesting to help orient us. Where are we in the market? What are investors doing? What is their sentiment? So on and so forth. So we looked at these over the last couple of weeks. I find these particular charts quite useful to understand what's going on. It's really looking at cohorts. So here we're going to use our long-term and then our short-term holders. And of all of the coins held by that cohort, how much of it is in profit or loss? That's the framework we're looking at here. And we do have the all-time average in green, plus standard deviation in red, and -1 standard deviation in purple. Now we can see that for our long-term holders, there is now 82% of them are now in profit, and we have broken above that midpoint line. This happened again in 2019, it happened again in 2020, and it happened in the mid-2016. So what we're really looking at here is this. I mean, historically, those periods have been a bit of a, we're no longer in the recovery phase. It's a bit of a transition towards the enthusiasm, right? The market's shown enough strength that people really start to believe, hey, this thing is actually going higher, right? Now, naturally, the more people that start to believe that, the more probable we actually move into some kind of a correction, or indeed the market starts to hit some kind of resistance. So again, what we're looking for here is we've kind of come off this recovery phase where it was all a bit uncertain, the market was chopping around sideways and people weren't quite sure where it was going to go. Once we got above that 30,000 level, more and more people started to go into profit, and that's going to start to shift sentiment. The more people are in profit, the more confident they feel. The more confident they feel, the more they realize it may not go down again. The more people believe the market won't go down again, the more likely that it is to go down again. This is just how markets work. They tend to move against the largest cross-section of people. So now that we have a supermajority of long-term holders, we can probably start to expect that sentiment moving not quite towards it's going up forever, but maybe towards it's going up for a long time. And we start to get those risks building, right? That leverage starts to build up. Short-term holders also almost entirely in profit. Now, this is expected because over the last 5 months, Bitcoin has had extraordinarily good performance. So basically everybody who bought in the last 5 months is going to be up on their position. We typically see this during the euphoric/enthusiastic. I'm not going to say euphoric just yet, but certainly the enthusiastic parts of bull markets. So in many ways, we can probably say that we have left the recovery phase behind us, most likely, at least by my read, probably down there at the 30,000 level, where that coin time true market mean price is. We can actually see this. I love this chart. I think that realized profit and loss is a real gem in on-chain analysis, because it's all well and good to theorize over where people are at, but it's another thing to actually look at what are they doing? What are their actual behaviors telling you? So this is looking at the net profit or loss being locked in on an entity adjusted basis. This is using our cleanest and most precise data, filtering out all the internal exchange transactions, the self-spends and all that kind of stuff. You can see we've been in a profitable zone where we've had sustained profit taking really since the rally in October. So again, that was the rally that took us above 30K. We've had periods of time, we've had dips below and losses getting locked in, and it was all a little bit choppy. In fact, let me just stick this on a 1-year basis. You can see it was all a bit choppy on the way upwards. It has been sustained profit taking. So we have now entered this period where there is sufficient demand to absorb that profit taking. But by and large, investor sentiment is now more positive, but these profits are being taken. And that, those are the things that generally put an uptrend, at least to some kind of resistance. Now, just before we say that, keep in mind the magnitude of profit being taken is still very, very small, certainly relative to the full euphoric phase of the bull. So that's why I say it's kind of in this enthusiastic type phase where it feels like based on what we're seeing. If we look at things from a SOPR perspective, which unlike net realized profit and loss, what we're doing here is going dimensionless, just looking at the average percent locked in. Now we've got various cohorts here, everything from entity adjusted to short-term holders to different variants of SOPR. And what I've just plotted down the bottom here is periods when all 5 of these, including long-term holders, are all in profit. And you can see that back here in around March 2021, we had the first signs that things were, again, a little bit choppy and all over the place, but we've seen this recovery phase starting to kick in. It's more positive than the doom of FTX. But really, since that October rally, we've seen a very sustained period where all cohorts are actually locking in profit. So again, speaking to that confidence, but also people starting to take just the slightest amount of chips off the table. Now, the last thing I want to touch on, because, and actually we're going to be exploring this in a bit more detail, so I just want to give the kind of a seed to think about. I have touched on this before, but I find this chart quite incredible, and I think there's a lot of information in here. What we're looking at here is SOPR, once again, entity adjusted variant in blue, Now, what I've done here is just subtract 1 to get onto a 0 baseline, because what I want to compare it to is the annualized funding rate here in orange. Now, I mentioned before that people start to get pretty confident and profits get taken. And, at some point in time, the market probably reaches some kind of resistance at the same time that everyone goes, it's going up forever. Generally speaking, we often see leverage start to build towards these periods because as confidence grows, people become higher conviction that it's not a good time to short. In fact, it's time to be very long. And you see this kind of overwhelming leverage build. Now, on just visual inspection, you can see that SOPR, which is the amount of profit or loss as a percentage locked in by the spot market on those coins flowing in and out of exchanges, and the funding rate, there's a lot of similarities going on here. There's a lot of similar characteristics between these two charts. And I've been spending a lot of time thinking about this, and the seed that I just want to leave you with, we're starting to see an uptick in positive funding rates. This means that there is more speculation, more kind of hedging, whatever you want to call it, whatever the mechanism, more people are bidding on futures in perpetual swap markets at the same time as someone in the spot market is starting to take profit. So essentially what we're looking at is two different groups of investors. One happens to be paying a larger interest rate for the privilege of having leverage in futures. The other one has held their coins probably for a reasonable amount of time. They're now in profit and they're taking some chips off the table in the spot market. These are two statistically meaningful subsets of the market. We're talking about billions of dollars in either open interest or coins flowing in and out of exchange. So what we're looking at is very meaningful subsets of the market. Their data and their behavior is just simply printed and displayed in different ways. So what we're looking at here, and I want to, again, I'll explore this more in some later pieces, but really looking at this dynamic between how do the futures markets tell a story and how do the spot markets tell a story? And what I see here is that in many ways, they're actually telling us the same thing, just from a slightly different perspective. I'll leave that one with you. And if you've got any comments or thoughts, be sure to drop them in the comment section below. So thanks for tuning in for that session, folks. Hopefully you found that one useful. Across many metrics, Bitcoin has done extraordinarily well this year, 140%. It really is quite spectacular given that it was dead, right? For 10 years was the narrative just a year ago. So truly quite remarkable stuff. We will see how it starts to trade as we go into the end of December when things generally get a bit lower liquidity. There's less trading activity. It will be quite interesting to see how Bitcoin performs at that point in time. But certainly across many metrics, it certainly looks like Bitcoin has transitioned from a recovery, that uncertainty phase, towards a more confident enthusiasm. And again, that comes with its own risks, but also it's a whole lot better than where we were 12 months ago. So, in many ways, the market has deservedly reached this point of enthusiasm. So anyway, hopefully you found that useful. Let me know if you have any comments in the section below. And do make sure you sign up to our Glassnode Clips channel if you get the chance, if you're looking for more bite-sized chunks. And otherwise, I will see you in the next one. Cheers.